If you're nearing retirement or you're already retired, you need to be considering how Bitcoin can bolster your retirement portfolio by boosting long term performance and actually, despite what many people say, lowering your risk. I'm Mitch, the founder of Strong Wealth, and in this video, I'm going to be revealing how an active Bitcoin trading strategy could actually supercharge your retirement portfolio returns and give you downside protection. This could allow you to spend more money in retirement without worrying about running out of money, or you could give more to your church or to your family and leave a greater financial legacy. Or this could make goals that you didn't think possible actually achievable, like buying that dream home in the mountains that you guys have always talked about. But I don't expect you to just take my word for it. Let's go ahead and dive in. This is our active strategy that our clients are using right now to get exposure to the upside of Bitcoin with the downside protection. Yes, even those clients who are nearing retirement or could even be in retirement or just retired. So I'm going to get into what the logic is behind our active strategy, and then I'll also get into the performance numbers, which is probably what you really care about. So let's go ahead and dive in here. All right, before we do, we just have a few disclosures we have to cover with you. So all performance data is hypothetical, meaning that if you were invested in this strategy from the time frame that I will show, this is what your performance will look like with these other factors in mind. So the other thing that I want to point out is net of fees. So all performance data will be net of a 1% management fee, meaning that a 1% management fee is included as if you had that fee throughout the hypothetical backtest. And number 9 down there, max drawdowns. So the max drawdowns are calculated on a month-to-month basis. Intra-month drawdowns are not reflected in the performance data. All right, let's get into the logic behind our strategy and then to the performance numbers. So Fluvius, that is the name of our active investment strategy. That is Latin for to flow. The idea behind it is this is a trend following and momentum driven strategy so that your assets are actually flowing to where the returns are coming from most recently in the markets or in these various asset classes that I'll get into in just a moment. So Bitcoin is included alongside traditional assets in this strategy. The other thing that I want to point out from this slide is that we use a disciplined risk management approach. Everything that we're investing in is decided on past data that we're running through our formula that we have crafted, and it spits out which ETF to own in each of these given sleeves, which I'll explain here in just a minute. And that's what we actually invest in. So we're not making these decisions on what we feel like is going to happen or on our own judgment. We're actually using strictly numbers to decide what to invest in this portfolio or when to go to cash if we're experiencing a market downturn in any of these asset classes. Right, so we have designed two separate Fluvius strategies, a 3-sleeve and a 4-sleeve strategy. In each of these, each sleeve is equal weighted and it is independent of the other sleeves. So what does that mean? We have an equal weight where you can see the 3-sleeve is a third, a third, a third. 4-sleeve is a fourth, a fourth, a fourth, a fourth. All right. And we have Bitcoin, equities, commodities in the 3-sleeve. And then we're adding fixed income as the 4-sleeve in the 4-sleeve strategy. Now, when I say that these are independent of each other, that means when we're making decisions around what to do within each of these given sleeves, we're making that decision independently of what could be going on in the other sleeves. And we are actually rebalancing back to these allocations on a monthly basis. We also run our logic behind the scenes on a monthly basis to update any investment changes that we need to make. If the same ETFs are produced from after running through our logic behind the scenes and it spits out the same ETFs in each of these given sleeves, then we will continue to hold those into the future. All right, so let me get into what I mean by that because that's probably a little bit fuzzy right now for most of you. One other thing before I move on, I just want to point out that we are solely using ETFs to execute this strategy. We're not trying to decide which companies are going to outperform. We're not trying to get that specific and predict the future with this. We are still utilizing more index ETFs or sector specific ETFs to gain exposure to each of these asset classes. It's also important to mention with Bitcoin, it is not spot Bitcoin we're trading in this strategy. We are utilizing the ETFs to gain the exposure to Bitcoin as well. So let's move on here. In the Bitcoin sleeve, this is the logic that we use to decide whether we should hold Bitcoin or whether we should hold cash in this portion of the portfolio on any given month. All right, so we're calculating a simple moving average. That is the white line that you can see here that is overlaid on top of the Bitcoin price chart, which is the gold line on this slide. So if Bitcoin's price is above this simple moving average, we are holding Bitcoin. If it is below the simple moving average, we are holding cash. Very simple and a non-emotional approach to whether we're holding Bitcoin or not. What this allows us to do is it allows us to catch the upward trends as the market turns around out of bear markets, and it allows us to go to cash when the overall trend turns bearish and we go into a bear market for Bitcoin. So as you can see, we're not trying to time the perfect bottom or the perfect top. We're simply trying to catch the trend shift after it happens and when we have momentum behind that trend. So what this does is this gives our clients exposure to Bitcoin's upside without experiencing the extreme market drawdowns like we've seen in Bitcoin historically, which could be up to 70, 80, or 90% based on Bitcoin's history. Let's go into the other sleeves very quickly before we get to the performance data. All right, so here's the equity sleeve logic. In the equity sleeve, we actually have what you could call two sub-sleeves, which are split 50-50 to gain our full exposure to equities. So we have an equity core sub-sleeve and an equity sector sub-sleeve. The equity core is index funds. So we're using index funds to gain exposure to different areas of the market, whether that's U.S. large cap growth or value or mid cap or small cap, or it's international or emerging markets. We're using those index funds, and then we are ranking the returns of each of the ETFs based on a past performance window. And the highest ranked ETF is the one that we decide to own in each given month. If it's the same ETF, we continue to hold it continuously until that changes. And if specific criteria are met during a market crash, then we are going to cash in the equity sleeves. Equity sector is more specific. So we're looking at different U.S. sectors and we're deciding what to own based on what has momentum and what has trend. This could be industrials, it could be finance sector, tech sector, it could be any sector within the United States, but we're getting more specific on sectors where we may be able to experience performance, even if the more broad market indices are actually down. All right, so similar sleeve logic on commodities and bonds. If you'd like to see this full presentation gone through, you can go to one of our previous videos. It's called a more intelligent approach to ETF investing, and we will break down all of the logic in each of these given sleeves and give you a more in-depth view if you'd like to learn more. I'm not going to talk about Fluvius 3. I'm going to talk about Fluvius 4, the 4-sleeve strategy, because this is what we see is usually a good fit for most people who are nearing that retirement age, or they have just retired, or they're in retirement already. All right, so this hypothetical backtest is from January 2014 to January 2025, again with monthly rebalancing back to the allocations I mentioned earlier, which are 25% for each sleeve. All right, so the S&P 500 starting there on the right-hand side, you can see if you invested $100,000 into the S&P 500 back in January 2014, your ending balance as of January 2025 would have been $394,225. That is a compound annual growth rate of 13.18% over that time frame. Fluvius 4, our 4-sleeve strategy, if you started with that same $100,000, your end balance was $1.47 million, a dramatic difference between your end balance. And this is where I say this portfolio strategy, or adding Bitcoin into your portfolio in general, could help you to spend more in retirement without worrying about running out of money, or achieve some goals you never thought possible, or possibly give more, to your family, or give more to your church so that you can have a greater impact. Those are dramatically different results. On Fluvius 4, The compound annual growth rate is 27% over this time. But I also want to point out the downside performance because it's usually very surprising for folks because they feel like, okay, Bitcoin is very volatile. If I have it included in my portfolio, I'm going to experience severe drawdowns, and that's not something that I can handle or stomach during my retirement years. So the S&P 500 to the downside, you can see down here, worst year, negative 18.23% over this time frame. Maximum drawdown, negative 23.95%. Versus our Fluvius 4 sleeve strategy, the worst year was negative 12%, 6% better than the S&P 500. In the maximum drawdown, also 6% better at negative 17.44%. So you actually get a better downside experience, helping you sleep better at night and have more peace in retirement. And you're not drawing down assets when your portfolio is down significantly or we're in a drawn out bear market. And you're getting 14% higher compound annual growth rate, at least over this back test. Nothing is guaranteed into the future, of course. But however, this is going to be dramatically different results if you're invested in a 60-40 portfolio or anything like that that's even less performative to the upside, like S&P 500. Even if it is helping you somewhat to the downside, you're getting significantly less growth out of your portfolio, where we can actually get a better downside experience with Fluvius 4 and a much higher upside, which is pretty incredible. That Fluvius 4 benchmark there in the middle column is just because it's something that we actually created. We created it because we wanted to make sure that our active strategy, the logic that we're applying, it actually outperforms a buy and hold portfolio. So that benchmark is comprised of 25% Bitcoin, 25% whole stock market equity ETF, 25% a broad level commodity market ETF, and a 25% high level bond market ETF. So if you purchase those at 25% allocation and you just hold over this entire time frame, those would be the results. As you can see, about half of the imbalance of Fluvius 4. So we can see there that we have a green light or a thumbs up that, okay, the active strategy that we're utilizing does outperform a buy and hold strategy with the same asset classes underneath at the same allocations, which is pretty incredible. So if you have any questions, drop them in the comments below or share this with a friend where you think this could be helpful for them. If you're interested in talking with us and learning more about this strategy, you can reach out to us at www.strongwealth.net. You can schedule a free discovery call there, talk with myself, and we can see if this could be a good fit for you. Thanks for watching.